Welcome to the Morning Download Podcast, your go-to resource for personal finance, economics, and market insights. In just 8 minutes a day, we provide valuable information to help you make better money decisions. Don't forget to sign up for our free newsletter at https://www.morningdownload.com/subscribe. Let's dive right in. In today's episode, we'll cover crypto prices, the potential AI job threat, recent earnings reports and forecasts, the hedge funds industry, and the importance of independent thinking in value investing.
According to the International Monetary Fund, IMF, the rise of artificial intelligence, AI, could result in the disappearance of 40 to 60% of jobs worldwide. This warning from IMF chief, Kristalina Georgieva, highlights the need for governments to establish social safety nets and implement retraining programs to mitigate the impact. Georgieva anticipates a more severe impact in advanced economies like the US and the UK, as white-collar workers are deemed to be more vulnerable than manual laborers. In these countries, approximately 60% of workers may lose their jobs due to AI. On the other hand, emerging markets like India and Brazil are expected to experience a comparatively lower impact, with around 40% of jobs projected to be affected. It is important to recognize that the consequences may extend beyond unemployment. Georgieva warns of potential social unrest and income inequality resulting from this situation. Furthermore, senior workers may face challenges in finding employment, and we are already witnessing the early stages of this transformation in various companies. Duolingo, for instance, recently made headlines for firing workers due to the integration of AI, and smaller startups are following suit. However, it is not all doom and gloom. While AI presents challenges, it also has the potential to drive economic growth. Goldman Sachs suggests that it could increase labor productivity and boost global GDP by 7% annually over a 10-year period. In other news, Microsoft has surpassed Apple as the world's most valuable public company, and Apple is offering unique discounts in China, aiming to attract customers. Additionally, the global economy's attention is on Taiwan as its citizens head to the polls. Finally, a member of the European Central Bank suggests that there may be no rate cuts this year. So it's that time of year again. Earnings season is here, and some big names have already stepped up to the plate to announce their results. Let's start with Delta, who had a fantastic year thanks to strong travel demand. Their fourth quarter profit doubled, which is no small feat. However, it's not all smooth sailing for the airline. They, along with other carriers, faced higher costs throughout 2023, and to make matters worse, Delta's shares fell 8% after they trimmed their 2024 earnings forecast. Not the ideal start to the year. Bank of America also had a bit of a rough patch. Their fourth quarter earnings declined, mainly due to hefty one-time charges. They were hit with a large pre-tax charge of $6 billion related to the transition away from the London interbank offered rate. The stock hasn't been performing well either, with a 6% drop this year after a meager 7% gain in 2023. Citigroup surprised everyone with a fourth quarter loss of $8 billion. The loss was mainly due to charges related to last year's regional banking crisis, CEO Jane Fraser's corporate overhaul, and overseas risks. These charges had a significant impact on quarterly earnings, amounting to $66 billion or $2 per share. To make matters worse, they are also planning workforce reductions and expecting more severance costs. JP Morgan Chase didn't have the best quarter either. Their profit fell after a $9 billion fee from regional bank rescues. Quarterly earnings dropped by 15% compared to the previous year. However, if we exclude those charges and some investment losses, their earnings would have been much better. Looking ahead, we have some exciting reports coming up next week from companies like Tesla, Netflix, and Microsoft. So stay tuned for that. Oh, and in other news, Boeing seems to be having a rough time. After the recent door incident, they now have to deal with a cracked window on a Boeing 737. This forced an all-Nippon Airways flight to turn back. Not great press for Boeing. Let's talk about hedge funds. Have you ever wondered what makes them so popular among investors? Well, let me break it down for you. Hedge funds are these pooled investment funds that use various strategies to generate returns for their investors. They handle big money too, with the industry being worth around a whopping $53 trillion. That's no small change. Now here's the interesting part. Hedge funds can invest in companies in different ways. They might buy private firms or even acquire a controlling interest in publicly traded companies. Some of the top dogs in this industry include Citadel, Bridgewater Associates, and AQR Capital Management. These are the heavy hitters, making big moves in the investment world. But wait, there's a catch. Hedge funds are normally suitable for investors with a high net worth. Why, you ask? Well, there are risks involved in this game. To mitigate those risks, these funds focus on highly liquid assets. This allows them to quickly cash in on one investment and shift their funds into another promising opportunity. Oh, and here's another thing to keep in mind. Hedge fund managers often use leverage to maximize their profits. Sounds great, right? Well, yes, but it also comes with increased risk. So it's a kind of double-edged sword. In a nutshell, hedge funds invest in a wide range of things. They dabble in individual stocks, including short selling and options. They also explore currencies, bonds, commodities, arbitrage, and derivatives. They're like the jack of all trades in the investment world. Today's quote is from Joe Greenblatt, a renowned value investor. He highlights the importance of defending our ideas and engaging in healthy debates. When our ideas are challenged, it creates a virtuous cycle that leads to clearer thinking and improved analysis. Greenblatt emphasizes that being an independent thinker is crucial for success as a value investor. As value investors, we strive to identify undervalued assets that the market hasn't fully recognized. However, it is equally important to understand why the market may not appreciate the value we see. Engaging in a back and forth during the investment process helps us uncover the reasons behind the market's perception. By asking and answering good, logical questions, we gain a deeper understanding of our own thinking and the market's perspectives. Through this process, we become better investors, refining our analysis and expanding our critical thinking abilities. It enables us to bridge the gap between our valuations and the market's perception. Ultimately, this enhances our ability to make informed investment decisions. So, let's embrace challenges to our ideas, engage in thoughtful discussions, and leverage the power of differing perspectives to grow as investors.
In today's episode, we explored stagnant crypto prices and the worsening political situation, discussed the potential job threat of AI and its impact on social unrest and income inequality, analyzed earnings reports from Delta, Bank of America, Citigroup, and JP Morgan, delved into the world of hedge funds and their strategies, and learned about the importance of independent thinking in value investing according to Joe Greenblatt. Thanks for tuning in to the Morning Download, your go-to podcast for personal finance, economics, and market insights in just 8 minutes a day. Don't forget to subscribe for more helpful content and sign up for our free newsletter at morningdownload.com/subscribe.